Introduction. Say. Most capital budgeting courses end with project selection, but in real-world practice, the process does not end when the investment is approved. Capital investment decisions require ongoing monitoring, auditing, and review. This is where the Post-Implementation Audit, PIA, comes into play, a critical but often neglected component of capital budgeting. A post-implementation audit involves the systematic review of a completed project to determine whether the anticipated outcomes were realized, the investment performance met projections, and what lessons can be learned for future decisions. It helps in ensuring accountability, improving forecasting accuracy, and enhancing managerial learning. This module provides an in-depth exploration of PIA frameworks, performance evaluation techniques, implementation issues, benefits, limitations, and strategic implications of post-investment reviews. What is a post-implementation audit, PIA? A PIA is a retrospective review conducted after the completion and operationalization of a capital project. It compares actual performance against the original forecasts and assumptions, covering areas such as financial performance, NPV, IRR, payback, operational efficiency, strategic alignment, environmental and social impact, stakeholder satisfaction. Objectives of post-implementation audit. Evaluate the financial returns compared to projections. Identify variances and causes between planned and actual outcomes. Detect and analyze implementation issues and inefficiencies. Enhance the accuracy of future forecasts. Ensure accountability among project managers and departments. Derive lessons learned for better capital budgeting in future. Validate whether the project aligned with the organization's strategic goals. Key dimensions of project performance evaluation. A. Financial performance. Actual versus forecasted cash flows. NPV and IRR comparisons. Break-even variance analysis. Payback period. Reevaluation. B. Strategic alignment. Did the project support long-term business objectives? Was market share, brand value, or competitive positioning enhanced? C. Operational performance efficiency of production processes, utilization of resources, capacity versus actual output. D. Schedule and budget adherence. Was the project completed on time and within budget? If not, what caused overruns? E. Risk management effectiveness. How well were anticipated risks mitigated? Were there any unforeseen risks? F. Stakeholder feedback. Customer user satisfaction, internal stakeholder feedback, employees' departments, regulatory compliance feedback. Steps in conducting a post-implementation audit. Define audit objectives and scope. Identify performance areas and stakeholders to be reviewed. Assemble the audit team, preferably independent of the original project team. Collect performance data. Actual financials, operating reports, stakeholder interviews. Compare with initial projections. Identify variance in cost, revenue, time, risk. Analyze variances. Determine root causes of deviations. Document findings and lessons. Prepare structured audit reports and learning memos. Recommend corrective actions for current, future projects and process improvements. Share learnings. Create a knowledge base for institutional learning. Tools and techniques for PIA. Variance analysis. Measure and interpret deviations. Benchmarking. Compare performance with industry standards. Earned value analysis. EVA. Integrates cost, schedule, and scope. Scorecards. Balanced scorecard for non-financial metrics. Root cause analysis, RCA. Drill into the origin of problems. SWOT review. Post-project strengths, weaknesses, opportunities, threats. Common findings from post-implementation audits. Overly optimistic revenue forecasts. Underestimated implementation costs, scope creep and budget overruns. Lack of post-deployment support. Resistance to change and adoption challenges. Unrealistic schedules due to poor planning. Failure to account for regulatory or environmental impacts. Strategic value of post-implementation audits. Builds a culture of accountability and transparency, supports continuous improvement, increases investment success, Rate by closing feedback loops. Empowers organizations to make data-driven decisions. Helps in talent evaluation and project governance. Limitations and challenges of PIA. Blame culture. May discourage honesty if focused on fault-finding, resource-intensive, time-consuming and costly to perform data gaps. Incomplete records limit analysis. Bias. Audits by insiders may lack objectivity. Delayed feedback. Findings may come too late to fix core problems. Summary of key learnings. Post-implementation audits are essential to close the capital budgeting loop. They offer both quantitative and qualitative insights. Emphasizing transparency, feedback, and continuous improvement ensures long-term strategic alignment and capital allocation effectiveness. Despite their limitations, PIAs are a vital pillar in financial governance, project management maturity, and investment control.